What's the most important resource that you have? If you really thought about this deeply, I think you'd come to the same conclusion that Joey and I did. It's time. In our newest book, Wealth Without Wall Street, The 3 Steps to Financial Freedom Through Passive Income, we talk about how are we tracking that time? What is the thing that we can do to get more of that time back?
That's right. If you've ever been listening to our podcast and thought, man, it would be amazing if I could take all the things that you guys have learned over the last 10 years and just summarize them, put them in some way to easily digest them and take action, that's what this book is all about. You're not going to want to miss it. Go to wealthwithoutwallstreet.com/new book and get your copy today.
All right, let's fire up this engine. I'm ready to start saving money by the second here, Stallion. And I think the best one to start with is how do we effectively reduce our expenses? Like, one of the things that many of us have is kids, and we spend a lot of money on our kids, and too oftentimes we end up buying things that we can't deduct, and like, volleyball, soccer, golf lessons, swim lessons. There's so many things that we can't, that our kids use that we can't deduct as a business expense. But there's some way that you're able to do that. Would you mind share with us what that looks like?
Well, I'll tell you, the number one way to go ahead and take care of those expenses is to have your kids pay them directly, right? Like, get them off their butts, get out there being creative, creating value, and let them pay for it. They say they want to sign up for piano. Good on you. Like, get over there and make some money and you pay for it. Okay. I'm done. But no, for real, the best way is, as a business owner, you have a lot of things that need to be done, right? You have tons of activities that you can pay someone for, and it just may happen to be your children who help you out of the business. And how this really works is you're able to take a deduction for anything that you pay your kids that they are helping you within the business. And they, as an individual, do not even have to pay tax on anything up to $13,850. So up to that number, you can pay your kids and you get a deduction on your business expenses, or not having to claim that as income. And they do not have to claim it as income. So it is a beautiful thing. Now, practically, I think the couple key things, and maybe if you want me to cover it all right now, I can. Or if you just want to introduce the idea and then break it down later, I could do that. What do you want to do?
I think let's just stay on point, man. You're hot. Right. Let's keep firing.
Thank you. Oh, well, I'll tell you, the big thing is number one, it will help your kids to understand that they can create value. And that to me is important. What I decided to do with my kids, rather than, and I've seen this done several different ways. There's some people that will pay their kids just a fixed amount every single month, and they don't base it off of any particular 1 or 2 or 10 different items that they did. They'll just say, oh, the general help, they help with social media or whatever. They don't have like a very specific per activity payment. And I think what happens with that is sometimes kids don't really understand the value that they're creating, because it's not tied specifically to 1 or 2 activities that they're doing. Or it's potentially, I think people overpay their kids for something they could have paid somebody else to do. And that didn't really work for me. And so what I did is I came up with specific tasks or duties that had a dollar amount attached to them. And I said, hey, as you girls do this, I will pay you specifically for those things. And I'll give you a couple of examples. Okay. Writing an email for one of my different companies, 100 Unicorns, for instance. I know, Russ, you love that company so much. And my daughters will write emails from time to time, and I'll pay them $25 for each email that they write, because I know that that's creating value for that brand, that they will potentially get customers to buy additional products. How about reading a book that with a report? So I also wanted to encourage them to do activities that would educate them and thereby becoming a better employee of the company, right? I think that that's also an incentive. One of my daughters did deal reviews for online business purchases, like specific business we were looking to buy. They did a deal review. They filled out a whole form, looking up all the things, researching all the things about that business. And I paid them $50 for filling out that review. Running errands for the companies, $25 for the trip. Whether that's literally going and dropping off mail or whatever the case may be, running errands for the business has certain things. So my point is you know in your business what things are worth. You know what things are necessary or important. Put a dollar amount to those things and then have your kids track their activities. And what I have found is when we switched to that model, they started to really value what they were doing, and they started to really dial in to all of those different aspects of the business. And man, I think that it's helped them progress and mature as children.
All right, David, what would you add to Joey's statement? Being the professional in the room, let's make sure this is the quick fact check here.
Yeah, Joey's doing a good job giving examples of activities to do. What I'd talk about is some of the mechanics on where to pay from. And since we all love a little bit of code sections here, let's see, I came up with a code section on this one, 3121B3A, in case you were curious and you just want to do some reading later. But the importance of that one is it directs or encourages the appropriate entity to pay a child from. So, for example, if I have an LLC tax as an S corporation or just an S corporation, or if I have a sole proprietorship or a partnership, I'm actually much better off to pay from a sole proprietorship or partnership. So, for example, if I've got rental property, I likely own that through a sole proprietorship or some form of partnership versus an S corporation. Those entities are better to pay from because, as that code section I just mentioned would state, you do not have to, your child is exempt under the age of 18 from Social Security and Medicare tax. So beyond that, I think all of it's on point. But we just want to exempt as many of those tax dollars as we possibly can. So paying from the right vehicle is done. And understanding how that works, if you're unclear. So, it may be common practice if you've got employees and you're already paying people to put them on payroll, whether that's through Gusto or your payroll provider. In the case of a sole proprietorship or a partnership, you don't have to go through that hassle. You literally just cut them a check and you write it out to them, deposit it in their own personal bank account. And as long as it's under that standard deduction amount of $13,850 that Joey had mentioned, they shouldn't owe any taxes on that. Now, just to clarify one other piece, since I guess we have the technical detail person on the call today, that $13,850 is total wages that they or earnings that they would have from any sources. So if they're, stuffing groceries at their local grocer and receiving a paycheck there, that would contribute towards that total $13,850 number.
Well, and you're spot on about the disregarded entity. I have not made that upgrade yet. And the second upgrade I'll mention is, Russ, you've had some experience with this, is streamlining the process through technology, like an app like Gravy Stack. We had our friend Scott Donald who came on and shared about that. It's not something I have set up currently, but that's something I want to do because I think it actually gamifies this process further and actually makes it simpler for us to track everything and make payments easily to them. Russ, what's been your experience on that particular side?
Yeah, I think anytime you can actually attach value to the money that they're receiving and also teach them how to create money, right? We want ourselves to be building streams of income. We wake up, instead of trading time for money, we want to come with the mindset of how do I create something that will create income streams for me in the future? I think we want to do that for our kids at a very young age, probably earlier than we ever considered it. I think that app allows for that. It gives them an opportunity to use both brain activities, but also physical activities to be able to do it. So I'm paying my kids through this app to do things as menial as like tasks around the house, but also as much as like doing research on, on online websites we're considering buying, reading nonfiction books and giving me book reports, coming up with, taking a course on how to be a better presenter as they're preparing for that in their classes, because those are skills that they learn that can utilize in the future to create streams of income. All right, JD, I'm coming to you now. I want to talk a little bit about real estate. We have a lot of real estate investors that are listening to you, and many of them know the benefits of real estate. They know, hey, this thing can appreciate. It can create cash flow not only throughout, but whenever I sell it. And there's this concept of depreciation. But for those who are not as familiar, there's also extra things you can get as if you go down the road of becoming a real estate professional. Speak into this a little bit for me.
I'm going to, much like David here, I've got some of these tax codes memorized too. And this is section 469C7. For those of y'all that are interested, section 469C7. I memorized that. It's, I'm kidding, I just looked it up on ChatGPT, but it is the real estate professional status designation. This basically allows you to do a few things. But first, let me explain, I guess, how you get it. So for me, when I started getting into real estate about 5 or 6 years ago, we're buying and flipping houses. And most of the house stuff that we do it's short-term, right? And it's chunky money and there's no long-term cash flow from it. But then we pivoted and started doing some short-term rentals. We had a couple of long-term rentals. And so trying to find ways to use real estate in a way that creates obviously cash flow and opportunity, but also I keep hearing about this opportunity for, tax deductions. I'm like, I don't know what this means, but I'm in. And so somebody had mentioned something about real estate professional status. And so I looked it up, and it essentially, it's like a special badge, if you will, that helps you with your taxes. Right. And so there's a few things that you have to do in order to be considered a real estate professional. And David, correct me if I'm wrong, but the first one is you have to be really involved. Right. So you have to be really active. So if you own a property, you can't just do nothing. Like, you need to actually be really involved in the managing it and the making decisions, the day-to-day operations, and those types of things. The second thing is that you need to spend more than half of your time in real estate. And then you also have to work at least 750 hours in real estate activities. Okay. So that's like 15 hours a week on working on just real estate stuff for a whole year. And once you meet those three things and you can document it, right, then you can say, hey, I'm a real estate professional, and your CPA can mark that down on your taxes to become a real estate professional. And there are certainly some benefits as well for being a real estate professional from a tax standpoint. And so some of those benefits would include things like being able to write off passive losses. So think about it like this. Let's say that you had, and I'm gonna dumb this down in a really clean way, so people like Joey and Russ can understand. Okay, let's say that you own a lemonade store.
Ouch.
Okay, you own a lemonade stand and a toy store. And let's say that the lemonade stand loses money, but your toy store makes money. You can actually use the losses from the lemonade stand to reduce the taxes that you owe on the money that you made from selling toys. So you end up paying less tax overall. So that's like the general idea of like a passive loss deduction. Okay. So if you have active income over here and passive losses over here, you can take those passive losses and write them off against the active income on the other side. Okay. You also get, is that right, David? Did I say that right?
That's right.
Awesome. Okay. So you just need a lemonade store, a lemonade stand, and a toy store, and this is easy for you guys to accomplish. The next thing is the depreciation deduction. And this is relatively straightforward. So basically, real estate depreciates, like it deteriorates over time. The value goes up, but the structure itself deteriorates and depreciates. And so you can actually write off that deterioration or that depreciation. So it's like if you have a bike, right, that gets old and worn out over time, you can actually write off little by little of that bike over time as it gets worn down over and over the years as you're using it, just like you can in real estate. And so it may not be much with one house, but as you stack multiple houses together, multiple structures, it could be a commercial, it could be multifamily, but that can become pretty significant as you start writing off that depreciation. So you get a depreciation deduction with that. You also get like a mortgage interest deduction. You can write off like property related expenses. So there's a number of things that you can actually use. And I think it also helps you too, correct me if I'm wrong, David, but also with your QBI. Is that right?
The depreciation?
Yeah, no, like the being a rep, being a real estate professional. Can that also help you with QBI or no?
Yeah, you should get it in either direction, whether you're a real estate professional or not. But there are some other advantages that you have as the real estate professional when it comes to QBI deduction.
Yeah. So those are just some of the things as being a real estate professional that certainly makes it worth if you are actively involved, making sure that you let your tax professional know that, hey, I am a real estate professional. I would like that status checked on your taxes to make sure that you can take advantage of those particular deductions.
So the big idea here, let me replay what I heard, is I'm buying real estate that gives me a depreciation, right? So an asset that is actually potentially cash flowing, hopefully cash flowing, also has this potential of giving me appreciation. I can take this asset and depreciate it, right? Which is a fancy word of reducing my tax bill. And if I go through all of the criteria that you said as a real estate professional, then I can even utilize that to offset maybe active income that I have in my day job, right? Many of us have jobs where we're bringing in active income and our passive incomes is just not great enough. True?
That's right.
All right.
Yeah.
Amazing. Like there lies one of those ideas of, hey, if I'm spending a lot of time in this, 50% of my time or more in the real estate, it might be worth me getting that designation to help offset that stuff. Any other ideas you would add to that, David?
Yeah, I'll just clarify a few things. On the active income component, that's going to be generally for most people, they're paying a higher tax rate there. So some of the advantages of real estate when it comes to that depreciation deduction is that most of our investments in our life are probably going to be taxed at a much lower rate of capital gains tax. But when we receive this depreciation, if we have other forms of income sources in our life, whether we're able to match it up with active income through being a real estate professional, or even if we're investing in a lot of other passive income activities, those income activities are likely going to be at a much higher tax rate than some other types of buy-sell capital gains activity. So depreciation is super helpful there. The other thing I'd mention on that is the opportunity to accelerate the depreciation. So depending on the type of real estate that you own, you can use something called cost segregation, where you're not taking just the straight line depreciation method, which is you're going to receive a straight line for the land, straight line for the building, and accelerate that dramatically. Generally how that works high level, if you've got drywall or carpet or plumbing inside of a building, that's going to depreciate, essentially wear out much faster than the building structure itself, or certainly the land. And so if you go through the process of cost segregation, hire a cost segregation engineer or firm, or maybe potentially even your CPA, they can actually break it out. And instead of maybe receiving $100,000 a month in depreciation, you might receive $400,000 or $500,000 day one, and then a much smaller amount over a longer period of time.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stallion, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before, go to what'swhatwallstreet.com/PIOS. There was nothing worse than walking into class when you're in school and the teacher saying, pop quiz day. Why? Because you were unprepared. Are you unprepared though for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
All right, David, I brutalized the term, the QBI deduction at the very beginning, because I really don't even understand what I'm saying there. Tell us what that is and how can we maximize it?
So QBI stands for Qualified Business Income. That would essentially be your profit of your business. So it came out in 2018. Trump worked really hard with Congress at the time to overhaul the tax code. And what really happened is that the billionaire players, your large corporations, essentially C corporations, your publicly traded companies, lobbied for really low taxes. It dropped their tax rate from, at the time, I think it was 35% down to 21%. And small business America rose up and got their lobbying force together and said, hey, this isn't fair. You're making all these tax cuts for C corporations, and it doesn't make sense for mom and pop to be a C corporation. It's extra compliance, it's extra headache, et cetera. We need a tax break. And so they came up out of Code Section 199A, what's called the 199A deduction, or Qualified Business Income deduction. And the value of it is that you get a 20% deduction against the profit of your business. So for an example, if I have $1 million of profit in my business, and I'll explain what kind of businesses qualify or don't qualify in a minute, I could receive a 20% deduction of that $1 million in profit, which means a $200,000 deduction against my tax rate. So if my tax rate was 30%, I can receive a $60,000 tax savings if I qualify for the entire 199A deduction. And now the definition of business is very broad. So as I was mentioned beforehand with JD, the 199A deduction is available for real estate. So you may not view that as a business. You might have just said, hey, well, I bought this Airbnb, or I bought this commercial real estate, or I have these other things that I rent out. That's not a business. Well, for the sake of the 199A deduction, it is. In fact, most activities like that qualify for this deduction. Now, your JOB, your job that you're getting paid a W-2 paycheck from, or if you're a contractor, likely does not. But many things do, except for a few specified service, trade, and businesses. Essentially, the world doesn't like, apparently, doctors, entertainers, financial advisors, and so they don't receive the benefit of the 199A deduction. But most everybody else does, and that is businesses. Now, there's a few limitations with it, and then I'll give you a quick spot check on your tax return, because I know everybody enjoys reviewing their full tax return, front page to last page, to spot check their CPA or TurboTax, whatever they may be using. But there's a few drivers of qualifying for the full 199A deduction. You don't just automatically get it. You have to pass one of 3 different tests. It's too complicated today unless everybody writes it all out. But the primary test is 1, wages, W-2 wages paid through your business. So for example, if I am an e-commerce business and I have $1 million of profit and I hire everybody out from the Philippines to be able to produce product for my business, and I don't pay myself a wage because I've been told by my CPA, the more in a wage I pay, the more in that Social Security tax that I'm trying to get away from my children. I also want to get away from myself. Let's say, for example, I have no W-2 wages in my entire company. Well, I get the lesser of that 20% or 50% of W-2 wages. So if I have 0 W-2 wages in my business, I now get the lesser of $200,000 or 0. And if I just had paid myself a larger wage right before the end of the year, I could have boosted that 199A deduction, paid a little bit more in Social Security and Medicare tax, sure, but probably netted out closer to like $50,000 in tax savings just by boosting that W-2. Now, in the real estate world, it works a little bit differently. So sometimes you need if you did a cost segregation, for example, you've used up most of your depreciation, and now you're pretty cash flow positive and tax positive on your real estate ventures, you probably are in a situation where you're now paying tax. You should receive the 199A deduction for doing that. And you can actually drive that in 2 different ways with real estate. One is, again, through this wage. You could set it up in a way where you actually pay yourself a wage. You have to be creative with that, because if you generally own real estate in a sole proprietor or partnership, you can't actually issue yourself a W-2. So you'd have to set up a separate entity that I issue myself a W-2 and then do what's called aggregation, putting them together. That's one idea. The other one is that you actually get the unadjusted basis immediately after acquisition as a part of going into this calculation. So calculation number 2, or limitation number 2 rather, for the 199A deduction would be 25% of wages plus 2.5% of unadjusted basis immediately after acquisition. Now I'm going to let Russ explain unadjusted basis immediately after. I'm just kidding. So,
Woo, man, I started
Thank you
sweating
so much.
I sweated more than Joey thinking he's going to the gym this afternoon. That's awesome.
So UBIA, unadjusted basis immediately after acquisition, is just a really fancy way of saying what was the purchase price essentially of the building that you purchased. So if I bought a building for $5 million, got rid of the land, and the building itself was worth $5 million, regardless of how much depreciation I've already taken or if I accelerated, it doesn't matter. My unadjusted basis immediately after acquisition was that $5 million. So I can take that $5 million, multiply that by 2.5%, and that's going to go towards that threshold where I'm comparing the lesser of 20% of qualified business income tax or this 2.5% of unadjusted basis immediately after acquisition plus 25% of W-2 wages. Now, I'm sure everybody on the call feels fully informed on the qualified business income deduction. But here's the simple spot check on where to start. You go to your Form 1040. If you're not sure what Form 1040, it's the first part of the tax return that starts to look crazy and doesn't make any sense. A lot of the stuff before it usually has summaries and things like that. But as soon as you see your name, which you should recognize, and your social security number that hopefully you can remember, below that on box, what is it in 2013? Box 13 on the 2023 tax return is going to have qualified business income deduction from Form 8995 or Form 8995A. If that number is 0 and you have something more in your life than a W-2 paycheck from work, then you should probably reach out to your CPA or whoever's helped preparing your taxes to find out why. Furthermore, if that box is less than 20% of your Schedule 1 box, let's see, which box is that on here? It's going to be box 8. So box 8 on your 1040, if you take box 8 times 20%, and that box 13 number is less than 20% of box 8, I would also reach out to your CPA or dig into your world to figure out why. It could be correct. You could be a dentist and you just don't qualify. You could have missed something the prior year and the number is correct, but you need to do one of these drivers this year, mess with your wage, look at your overall entity structure, aggregate together, and actually increase that 199A deduction. Depending on the size of your business enterprise, this can be substantial. The one other driver that I would mention on here, if your income is low enough, your taxable income, that is. So for 2023, for example, the taxable income amount that, let's see, what's our method here? $364,200 if you're married, filing jointly, or $182,100 if you're a single filer. If you are under that amount, and you own a business or piece of real estate, something that qualifies for the 199A deduction, you automatically get the full deduction. That does not mean that TurboTax or your CPA automatically thought to put it in there. But if you know, for example, that your taxable income is under those two thresholds, you automatically receive the full deduction. And you should also think to yourself, if my income is under there, I shouldn't be trying to do extra work relative to my wages or other drivers to be able to maximize this deduction. Otherwise, you'll start to minimize the deduction. So understand where you are from a taxable income perspective and understand at least those couple boxes on the tax return to spot check. And this could be something to add a lot of value.
Immediately, tribe. Press pause, hit rewind, go back and listen to that, pull up your 1040 as we literally are doing this. I'm seeing that the deduction for 2022's tax return was only about 10.5% of what line 8, box 8 was. So I want to know why. Like that's an immediate check for somebody who finished intermediate accounting 1 with a D, a good D, by the way, an amazing D, best D I ever got in college. But for somebody like me, I can go there, I can check that, and now I have the opportunity to go figure out. So this immediately for me is an opportunity. If I could double that, man, think about what the time on investment of just listening to this one podcast would be worth, if that's for you as well. All right, I get the privilege of wrapping this up, and then David can tell me all the things I said wrong. One of the things that we all possess in some shape or form is probably a home. If you own your home, I'm talking to you here, we have a chance to rent out our house up to 14 times in a year and not have to pick up the income and pay federal income taxes on it. And then we can thank Dwight Eisenhower for that, where he came up with this rule for Augusta National. People just got finished watching the Masters. He's very popular in that area. I think they named a Army base there after him. I think they even have a statue there in his honor. And
they have a street there named going right into the front of Augusta. I was just there and I saw it and I thought, it's interesting. They must really like this guy.
Well, because he was helping people who lived there, who wanted to flee during the Masters, and they would rent their houses out, and he gave them this benefit at the time of 7 days that they could rent their house out and not have to pay income tax on the income. Well, here's how we can apply that in lots of different areas. Some of us would use this strategy in order to rent our house out when we want to go on a week vacation, a 2-week vacation, and we want to pay for it. Maybe that's you. You're like, hey, I'm willing to put my house on Airbnb for a week or 2 weeks for that period of time and allow that income that I don't have to pay tax on to fund my vacations. I know people that are doing that. For others who are owning our own businesses, we can utilize this in a different way. We probably are at the point where we're maybe wanting to have meetings with our teams. We're wanting to invest in our team members. We're wanting to maybe be on the same page more frequently. We can utilize this in a way where we have team meetings. So what is this qualification? What do we need to do? So we talked about tax code. If you go to 280A in the tax code, it will tell you all the specifics around this. But one of the things that you need to do in order to be able to rent your house out for up to 14 days and not pay federal income taxes, well, you need to have a rental agreement. You need to have an invoice. You need to have a legitimate business reason, an agenda, at least 5 to 6 people. Do it for at least 4 to 5 hours, and that's both prep and cleanup. Your house needs to have a cooking, bathing, and bathroom in it. And you can do this up to 14 days to rent your house out for the purposes of hosting a business meeting. Now, what are those qualifications? How can you actually do this? Well, for us, our team gets together twice a month in person for the team that's local. So Joey and I will invite the team over to our houses. We'll have an agenda set up. We will meet. For the day, we'll have a conversation, and then I will rent my house out. Now, JD, I don't know if you know this, but I rent my house out for $3,900 for that one day. And people were like, wait a second. How is it that you're renting your house out for $3,900? Where did that come from? Well, I did not come up with that amount. I actually had a third-party appraisal company come in. They took the square footage of my house, and then they went and appraised and looked at all the different houses and facilities within a 5 to 10 mile radius of us who rented out their space. And they took into account, most of those were wedding facilities, people that were hosting, corporate events and hosting wedding receptions and even wedding parties. And if you've ever paid for a wedding or you're about to pay for a wedding, you know how expensive it is to rent those places out for like 3 to 4 hours. If you want chairs, it costs extra, right? you want catering, you have to bring that in or pay for it. Well, the same thing can be held true for yours. I could choose any one of those venues to bring the team over. As long as I had a legitimate business reason, I could do that. So for us, we bring them to our house because you know what? I feel more comfortable, David, with my family here, right? I don't have to worry about, because we homeschool, I don't worry about like if I were to take them to a facility while I'm doing our team meeting, what could they potentially be getting into? Who's around, right? Not to mention, like, I just like my bathroom better than other people's bathrooms, right? I like the fact that I like my own chairs. Well,
it's a good bathroom, Russ. It is.
The appraiser says to us, hey, per square foot, your house would, if you were to rent it on the open market, it'd be $3,900 for a 4 to 5 hour time frame. I'm like, cool. Well, if I could rent it out to someone else for $3,900, I'm going to just rent it out to my business. Well, how does that apply to me? How do I actually save money there? So my business actually writes myself and my wife a check personally for $3,900 every single time. I document the meeting. I actually write a check. I cash the check. I have the agenda set aside for this, and up to 14 times a year, I could do this. Now, I mentioned this a second ago. I think this is important. For some of you, why did Russ say it needed a cooking facility, a bathing facility, a bathroom? Because I know people who own boats, who own RVs that are utilizing this strategy. And is also, they own multiple homes, right? They have a home in the mountains. They got a home at the beach. They got a home at the lake, any or all of the above. And they're like, I would like to be able to, do work events there. Not only just bring my team, but I would actually like to do a actual business meeting there. Now, can I bring just JD over and he and I just watch a ball game and write that off at $3,900? The answer is no. Remember what I said? You had to have at least 5 to 6 people. You need to justify the meeting. It has to have a legitimate business purpose. Now, what I understand too, David, you correct me if I'm wrong on this. If I'm bringing the team over, if this is actually my office, my business, then we can get out in the pool. We can have a great time as long as I get the whole team there. That's an expense, so it would be a legitimate business reason. But if I just ask the three of you guys to come over and, hey, let's watch the ball game and hang out in the pool, now that's no longer a legitimate business reason. But if I were to do a presentation and take 4 to 5 hours, we're talking about how to build a mastermind, for instance. So we're talking about ways to grow our businesses, and I'm sharing with you guys a strategic way that you guys can invest in my business. Now, again, that becomes one of those legitimate business reasons that you can do. All right. I know I probably missed a few things. David, how would you clean that up?
Well, it's good. Section 288G, if you, again, want to get your reading on. The other thing would be just a little caveat on the utilization of that home. The primary premise cannot be for entertainment. You know, you've got a 50% deduction on meals, and so it can't just be for your own personal meals. If you do have 5 or more of your team and you're providing meals for them, you get that up to 100%. When the primary purpose from a business perspective, whether it's your home or whether it's a Dallas Mavs game or whatever it might be, entertainment is no longer deductible, 0%. And so if I'm renting out my own home, it has nothing to do with the 288G rule relative to the home rental. It has to do with what I can take a deduction for from a business perspective. And so I want to have annual planning at a really swanky fun home that happens to have a pool, and therefore I had to pay more for the home versus have a pool party with the company and, you know, rent out a place for the pool party. So semantics here, but you know, if you're sitting in front of an IRS auditor, which probably none of us ever will, it'll matter at that point in time.
Well, hopefully that was enough details for you on 4 different strategies as we broke down the QBI deduction, how you can pay kids, how you can utilize your home as a potential way to offset taxes, or how depreciation around real estate works and the potential extra benefits if you decide to become a real estate professional and spend more than 50% of your time doing that. If you found value, take time to rate and review the show. We'd love to hear from you. Maybe even screenshot this and tag us on social media and say, hey, this is what I would like more of, and we will continue to create more content. David, thank you so much for coming in as a guest, man. Grateful to have you. Thank you, JD and Joey. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.